All right, so let's talk about valuing property today. So if you look at valuing property in the insurance context, we have a couple different terms that we need to address that have some significant impacts on how policies are going to play out. One term is cash value. So that's the value of the property in terms of cash if you actually bought the property right now. So what it would cost to buy it in its current condition. Replacement cost is what it would cost to replace the property, which means that there's going to be no deduction for depreciation. Depreciation is when things lose value due to being old and so forth. And then we have appraised value, which is going to be sort of an assessed or appraised, through an appraiser value for things that are harder to value. So think artwork or something of that nature. So let's talk about this a little bit more detail. Let's give some examples. So let's suppose we look at a home. In certain areas, let's say I'm looking at an older home, a cash value would have cost to sort of buy that house, right? So if I buy the house, I pay cash value. And that's going to be whatever the sort of end result is, factoring in how some of the home is older and things like that. Replacement cost would be, well, if my house burned to the ground, what would it cost to actually rebuild this and replace it? And very commonly, that replacement cost would be significantly higher than the cash value. And the reason for that is because if I'm replacing the house, then I'm going to be building it new. And if I'm building it new, then things are going to cost more. So if I have to put in a new dishwasher, I'm putting in a new hot water heater, I'm putting in a new furnace, I'm putting in new things. Whereas if I just bought this house that had been on the market for a while and it was an older home, those things were older. They weren't worth as much. But if I try to rebuild this and deal with replacement cost, that means that there's no deduction for depreciation. And so typically that is going to be more expensive and more cost to replace it. Appraised value would be, like I said before, more along the lines of something for like artwork or jewelry or something like that. There isn't necessarily a market that I could look at as easily to get cash value. I wouldn't be rebuilding it quite the same way, or maybe it wouldn't even be possible to rebuild it if it's a piece of artwork. So that might be something where an appraised value, where we look at some qualified appraisers to figure out what the value of something would be. So how it would relate to your insurance policies then, if I had a homeowner's insurance policy and I'm looking at the structure, maybe the house might have, let's say the house cost $200,000 to buy, cash value, but if they just burned to the ground tomorrow and I had to rebuild it, it might cost, say, $300,000 to rebuild it because it would be so much newer, it'd be built up to new code standards and so forth. So cash value might be $200,000, replacement might be $300,000. So really probably what you'd want to do if you're doing a policy is the replacement cost, because the reality is if the house burned to the ground, you're looking at a replacement scenario, not just a cash value. And if you just had a cash value policy, you're going to be building a much smaller house when the house burns to the ground. And so that's kind of the idea there, that you probably, when buying a homeowner's policy, want to make sure is it a cash value policy or is it a replacement cost policy? Probably the replacement cost policy is going to be the one that's going to achieve the results you would actually desire in the event of some kind of catastrophe there. So something to be aware of when looking at how property is valued. Thanks for watching and have a great day.